All right, let's get right into it. We're going to break down how you can invest tax efficiently here in the UK. And honestly, getting this right is one of the biggest, if not the biggest levers you can pull to really grow your wealth. So today, we're going to build a really clear blueprint for you to follow.
And this, right here, is the absolute heart of the matter. We spend so much time and energy trying to pick the perfect stock or the hottest fund, but the real game changer, it's the wrapper you put it in. The difference between a smart choice and a not-so-smart one, well, it can be staggering over time.
That's the big question, isn't it? Well, the good news is it's not about finding some secret, complicated loophole. It's about understanding the powerful, government-approved tools that are available to all of us and just using them in the right order. So let's build that strategy step by step. First up, the absolute foundation of any UK investor strategy, the individual savings account, or as we all know it, the ISA. Look, if you're not using this, you are pretty much just turning down free money. It is the non-negotiable starting point for everyone.
This is the magic number. You need to burn this into your brain. Every single tax year, you can put up to £20,000 into an ISA. And all the growth, all the dividends, all the income that's generated inside that wrapper is completely and utterly tax-free. Forever. So what's the catch? While the trade-off is simple, but it's really crucial. On one hand, an ISA is super flexible. It's easy to set up, and those tax benefits are permanent. But on the other hand, that £20,000 allowance is a use-it-or-lose-it deal. If you don't use it by the 5th of April, poof, it's gone for good. You can't roll it over.
So just to be crystal clear, this is for pretty much everyone. Doesn't matter if you're a seasoned professional, a business owner, or just starting out, maxing out your ISA should be priority number one before you even think about investing anywhere else.
Okay, so once your ISA is sorted and you're using that allowance, it's time to level up. Now we get to the tools that offer these incredible government boosts for long-term planning. I'm talking about pensions and the lifetime ISA. And wow, this quote just captures the power of pensions perfectly. They take tax efficiency to a completely different level, especially if you're a higher earner. It is an unbelievably potent tool for building a serious retirement pot. And here's why. When you put money into a pension, the government gives you tax relief at your highest rate of income tax. So let's break that down. If you're a higher rate taxpayer on 40%, for every £60 you put in, the taxman literally adds £40. For additional rate taxpayers, that boost is even bigger. It is an instant return on your money before it's even been invested a single day. But here's the deal. That incredible upfront bonus, it comes with one major condition. Your money is locked away until you're approaching retirement age. So you're trading access to your cash today for significantly more wealth tomorrow. It's a powerful commitment, but it is a long-term one. This makes pensions a total no-brainer for high earners, since they get the biggest bang for their buck from that tax relief. But really, it's for anyone who is disciplined and serious about building a comfortable future for themselves.
Now, let's talk about a really cool, special tool that kind of sits between an ISA and a pension. If you are between 18 and 39 years old, the Lifetime ISA, or LISA, is honestly one of the best deals out there. It's specifically designed to help you with one of two major life goals.
And here's the killer benefit. For every pound you put into a LISA, up to £4,000 a year, the government just adds 25 pence. So you put in £4,000, you get a free £1,000 from the government. Every single year. It's a straightforward, incredibly generous bonus.
But, and you have to listen to this is a huge but, you must pay attention to this warning. The money can only be withdrawn tax-free to buy your first home or after you turn 60. If you take it out for any other reason, there's a penalty, and it means you will get back less than you put in. So use it for its purpose, and it's brilliant. Use it for anything else, and it will cost you.
All right, so once you've laid the foundations with your ISA and you're using those long-term power tools like pensions, only then do we move into the specialist tier. These are for experienced investors looking for very, very specific tax advantages. And I really cannot stress this enough. We are now entering high-risk territory. These schemes offer massive tax breaks for a reason. It's because you are investing in smaller, younger, and much, much riskier companies. This is not the place to start your investment journey.
Now, the benefits here are compelling. I mean, schemes like Venture Capital Trust or the Enterprise Investment Scheme offer huge income tax relief. We're talking up to 50% and can even help you put off paying capital gains tax. But the government offers these incentives to encourage investment in the small businesses that drive the economy, and the risk of you losing all of your capital is very, very real.
And let's just quickly clarify premium bonds. It's important to know they are not an investment. Think of them more like a savings account, where instead of getting interest, you get entered into a monthly prize draw. The prizes are tax-free, which is great, but there's no guaranteed return. That means inflation is probably going to eat away at the value of your money over time. It's about keeping your capital safe, not making it grow.
And a quick word on property. A buy-to-let property isn't automatically tax efficient, not at all. The structure is what matters. You know, for some hassle-free exposure, you can invest in things like property funds or REITs, those are real estate investment trusts, and you can hold them all inside your tax-free ISA or pension.
So, we have covered a lot of ground here. How do we pull this all together into a simple, actionable plan? Okay, let's create your tax-smart blueprint. Here it is. The order of operations is crystal clear. Step 1. Fill up your ISA. That's the foundation. Do not pass go until this is done. Step 2, if it suits your long-term goals, maximize your pension contributions to get that sweet, sweet tax relief. Step 3, if you're eligible, use the LISA for that incredible 25% bonus. And only then, only once all of that is done, should you even begin to explore the high-risk, high-reward advanced schemes.
And honestly, this is the perfect way to sum it all up. This isn't about doing anything shady. It's about understanding the generous, totally legitimate incentives the government has created to encourage us to save and invest for our own futures. It's simply smart financial planning.
So, the final question, that's for you. Looking at this blueprint, where is the next logical step for your own financial journey? Is it finally opening that ISA? Is it bumping up your pension contributions? Or maybe looking into a LISA? Deciding on that very first action, that's the most important step of all.